we're going to get a general overview of accounting and finance, and the succeeding lectures will fit all the elements into this overview. So it's quite important to get an idea of the big picture. These are the learning outcomes. You can look at them as you wish, and we'll pick them up as we go along. So accounts measure the performance of a business. They start off by looking at the financial transactions, which they collect into accounts, which take each type of transaction. So sales will be one account, debtors will be another, fixed assets will be another. So transactions which involve sales, the sales side of a transaction will go into a particular account, acquiring an asset into an asset account. These accounts then reported into two major statements. One is the profit and loss account, and the other is the balance sheet. Nowadays, these terms are often used: statement of financial position and income and expenditure statement. They're the ones used in your textbook. However, major companies will still use the old terms. So you have to get used to both terms being used and some variation on those terms. The annual report down here is the set of accounts that all limited and public limited companies have to prepare. For a public limited company, there are also lots of other requirements through company law and through accounting conventions. These reports are seen by the outside world. Investors look at the report. It's published. You can download it from the internet. There is also another set of accounts, the internal management accounts, and these are the planning and control accounts that the company devises in order to help management take decisions and to run the business. The annual report has a number of interested parties. These the providers of finance we'll look at first. First, we have the owners. In the case of a limited company, the shareholders who have contributed capital to the company, and they, as the return for their investment, they receive dividends that are payments out of profits. Lenders to the company will include banks and institutions such as insurance companies, and the company will issue bonds, that is IOU notes if you like, that are traded on the markets, and it's a way of raising money. In the case of bonds, there'll be fixed interest payments and guarantees of security if there's non-payment. Suppliers are also providers of finance. If Tesco's buys goods, it may pay for them 80-90 days later, should pay for them 30 days later, but during that period the supplier is in effect lending them money, and when it pays its supplier, it's paying off this kind of informal loan. The other parties, as you can see, managers are obviously interested in how the company looks to the outside world. Customers may be interested, competitors obviously interested, employees in wage negotiations. The government is concerned about the regulation of the markets and the behaviour of companies, so they will be looking at accounts. One of the requirements imposed by government, for instance, is the need for them to report directors' remuneration from political pressure about the difference between the highest and lowest paid in the company. Community representatives, pressure groups of all sorts will be interested in the accounts and what they have to say about various aspects that they're interested in. So maybe a pressure group for organic farming will have a look at the accounts to see if there are any initiatives announced in the annual report. And investment analysts, they'll be chiefly interested in, I don't know if you can see that, it says annual report and financial statements. They'll be interested in the financial statements, in other words, the balance sheet and the profit and loss account, along with all the notes that accompany those statements. So I'd encourage you to have a look at annual reports. This link, I'm not sure if that's going to work terribly well. If that one doesn't work well, we all know about links that go down. This one will work for you, only it is quite difficult to find the actual accounts there. Whether that's deliberate or not, I don't know, but it is possible to find the accounts of Rolls-Royce. I've also included this as an example of how business is these days, and we have the example of Leyland Trucks. Leyland is a small town in central Lancashire, north of Manchester. They've been making trucks there for over 100 years. Originally an independent company, then it was taken over in the 60s by British Leyland, and then by a Dutch company, DAF, who make trucks. You see they're signed on the front of trucks. And then DAF Trucks was taken over by an American multinational called PACCAR that nobody's ever heard of. They owned DAF, and DAF owned Leyland, and so PACCAR now runs Leyland, and these Dutch trucks are made in a UK plant that is owned by a US company. The accounts are US accounts, reporting according to US accounting standards, which are slightly different. You can have a look at their accounts with that link, and then if you want to have a look at the accounts of any company, you can go to Companies House, and they will search, they'll do a name search. So for example, in Didsbury I could trace the accounts of our local fishmongers, knew the name they were trading under there, and under the name of the limited company, and I could see their sales for the year. It's quite interesting. And there you go, you'll find filed there the profit and loss account and balance sheet and some notes. For smaller companies, the reporting requirements are considerably less than, say, for Rolls-Royce. Rolls-Royce accounts will stretch to 200 pages or so. Do have a look at these reports. They are reporting on the performance of the company. They have lots of things to say about the company. And by the end of the course, you should obviously be able to understand a lot more about from the reports and be able to analyze the company's performance. What can we say about the information in these reports? Well, we have all these kind of reasonably obvious statements. Relevance is one thing that is perhaps obvious, but predictive value, not so obvious. An investor is not interested in the past, and yet the accounts are an account of the past. So what relevance do they have? Hopefully they will help the investor make an estimate about what they think the future is going to be. So it's the relevance to the future that makes predictive value useful. Then the confirmatory value, accounts are produced every year. During the year, lots of economic events happen, and people make guesses as to the effect on the profitability of the company. The accounts kind of establish what the effect was of whatever happened during the year. So it kind of confirms the rumours, and people can see what actually happened in financial terms. Then we have at the bottom here some understandability, verifiability, timeliness and comparability. Verifiability, the accounts must trace back to the original transactions, and auditors check the system independently of the company, hired by the shareholders to check the accounts and verify them. So that is quite a big exercise. The accounting information system follows this reasonably logical pathway. Information has to be identified. If we looked at the Rolls-Royce accounts, for example, it splits the sales up into its various divisions. Marine division, aircraft division are two of the divisions in the company. It doesn't have to split them up, but if the sales are not divided in that way, then we're not going to know what the division was. If it's not reported, then it's not going to be known. So it needs to be identified. And what accounts you do identify and don't identify is a problem, because you can't identify every single transaction. You have to make some summary. So how it's summarized determines whether information is going to be identified or not. Then the accounting system records the transactions. The profit and loss account and balance sheet analyzes the company's activities by further aggregating the accounts, and that is also the reporting format. Now, we saw in our original diagram that there were financial accounts, those are the ones reported to the outside world, and there are management accounts, the accounts that the managers use in order to control and take decisions. I undertake voluntary work for a small limited company, and every month we prepare a profit and loss account for that month. And also we compare it with what happened in the same month the previous year. We look at the balance sheet as at the end of the month, and every 3 months we make predictions as to what we think the year end is going to look like. That's the kind of information a company would prepare on a monthly basis, and that's all part of controlling the organization, looking to the future, helping the managers take decisions. The financial reports, as we've been saying, is every year. It's prepared according to strict accounting conventions. It's more general, it's highly regulated and audited, and it's also part of a report that will include a lot of other information. So there are differences in the nature of the reports. There's a difference in the level of detail, much less detail in the financial accounts. Regulations exist for financial accounts, they don't exist for management accounts. Reporting interval is much shorter for management accounting. Time orientation, the management accounts are looking more directly at the future. The financial accounts are looking predominantly at what happened over the previous accounting year. So the range of management accounts is much wider. The quality of information is perhaps rather different, in the sense that management accounts are not as regulated as the financial accounts. There are several features in that affect accounting. Sophistication of customers. People want to know more about what is happening in a company. transparency is the key term there. People feel that everything should be out in the open. The development of a global economy, we talked a little bit about that when looking at the Leyland trucks. The rapid changes in technology, we've seen the revolution of IT, information technology, computers, and that is causing large structural changes in society. Do we need bookshops anymore? Do we need shops anymore with Amazon? And these are fundamental questions on what is going to happen in the future. Deregulation of domestic markets. Well, multinational companies can't operate unless domestic markets are open to the outside world, and that involves deregulation. Pressure from owners as a result of all these other changes. The shareholders are concerned about the management issues. For example, with Rolls-Royce, there's a hedge fund investor that has 10%, owns 10% of the shares. They believe that Rolls-Royce should sell off its marine division and concentrate on aircraft. They have also insisted that they have a director on the board. So they are putting pressure on the company to over major strategic decisions. Increasing volatility of financial markets is another factor. Markets do periodically engage in high volatility, which is just a way of saying that the share price goes up and down a great deal. It's not a continuing trend of volatility. It varies a lot. It has been extreme in the past as well. We have experienced the global recession of 2007-8, and there were large share price changes then, and a subsequent slow recovery. That sort of thing is what is being referred to when talking about volatility of financial markets. So we end more or less on one of the key features with accounting. Accounting is there to help decisions by investors, in particular the owners. The accounts are actually prepared, well, they were prepared originally for the owners, and to a certain extent the government and all the other parties are just sort of piling in on it. But it is risk and return. Well, not quite risk and return. It is expected return. If you take a risk, you don't get a guaranteed return any more than if you put money on the horse with long odds. You're taking a high risk with your bet. It's not guaranteed to come in. Expected return means that although this is an expectation that of what is going to happen, it could be much higher return, or it could be a much lower return. It's expected in the sense that it is the return that you, on the whole, think will occur, is most likely to occur when you make the original decision. The actual outcome can be very different. So you must never forget the word expected, because it is key. The return as a definition is, well, it's defined variously, but essentially it is profit over investment. Then risk is, as we've been saying, the potential variation around expected outcomes. And there's no simple measure for that. There's a statistical measure of the standard deviation, of course, but that doesn't always encompass all the aspects of risk. This concept underlies a great deal of finance, and we will be returning to it in particular when looking at investment. So we have here our conclusion. Here it is. See if you can download a set of accounts from the internet, and what does it tell you about the company. So have a look at that, and that's independent of your seminar work. Just see what it's saying. Look at it out of curiosity. No particular exercise involved, but it will help familiarize you with the reporting. I will prepare a separate video on the Rolls-Royce accounts, and you may want to have a quick look at that.